This advanced liquidity concept will change your trading game. Majority of traders only know about the basic liquidity such as trendline liquidity, such as double top or double bottom, or you can call it equal highs and lows, or old highs and lows. These are the basic liquidities that most traders know about, and this is why they often get used as liquidity in the market, right? In this video, I'm going to show you how you can be a step ahead of majority of traders by understanding this liquidity concept or this type of liquidity. Now, amongst these three types of advanced liquidity, the most important is the structural liquidity. So if you don't understand any of these ones, ensure you understand these one very well, right? It will change your trading game, I promise you. So what is liquidity? Liquidity simply means money, right? Liquidity means money. Liquidity is a fuel that moves price from one point to the other in the market, right? And the market always moves in search of liquidity, right? The market is always in the hunt for liquidity. This is why a lot of people get stop losses because the market loves to take liquidity, right? So while you get a loss and you're angry, the market is happy always. The market always wants to get your liquidity, wants your money drown into the market, right? And this is why I've brought this video your way so you can know how to position yourself to avoid some unnecessary losses while you're trading, all right? So like I said, liquidity is what moves price from one point to the other. And I've already told us the basic type of liquidity that we have. So we're just going to go straight to transactional liquidity. So what is transactional liquidity? Transactional liquidity, let me give us a pictorial representation of transactional liquidity. Now, when price takes out transactional liquidity, it retraces, right? So let me just put it in here. Transactional liquidity is responsible for retracement, right? Responsible for retracement. This is responsible for expansion. This is responsible for expansion, right? And structural liquidity is responsible for continuation, right? For continuation. So this is the basic function of this liquidity you see here. Retracement, for continuation, and for expansion, right? Now, whenever price takes, so this is a bullish trend, right? Let me take this out. This is a bullish trend. We have something like this. Now, whenever price takes out this liquidity, right? Whenever price takes out a higher high, or in the case of a downtrend, whenever price takes out a lower low, right? To create a new lower low, we say liquidity has been taken, right? Transactional liquidity has been taken. This is a transactional liquidity, and this is a transactional liquidity. Now, whenever this transactional liquidity is taken, price is expected to retrace, right? Price is expected to retrace before another impulsive move. Now, if price fails to retrace after taking a transactional liquidity, then immediately price becomes inefficient. Immediately price becomes inefficient and unhealthy, right? So if price goes on to create more structures ahead without coming to, without retracing after taking out this transactional liquidity, price is eventually going to come back, take all of these liquidities here, right? Tap into this demand zone, right? To balance to make price efficient for another leg up, right? So this is basically what transactional liquidity is all about. Now let's look at chart examples for it. Let's look at chart examples of a structural liquidity. Look at this, for example. Price took out a structural liquidity here, and look at what price did, right? Price had to retrace. Price had to retrace all the way, right? All the way before another leg down, right? So whenever a transactional liquidity is taken, it is expected for price to always retrace. Now let's look at an example where price took out the transactional liquidity and failed to retrace. Okay, look at this, for example. This is a good example. Look at this. This is a transactional liquidity. Price took this out and failed to retrace, right? Price failed to retrace into this zone, right? Into this demand zone. So automatically price became inefficient here. All of these things you see around here, right? All of these move from this zone here is an inefficient price. So if anyone gets to take a trade, right? Let's say you see your model play out here. Let's say whatever strategy you trade, maybe I don't know, maybe whatever strategy you trade, you decide to take a trade around this zone, you're definitely going to get a stop loss, right? Because price has taken a transactional liquidity and has failed to, retrace, which is expected of price for price to be inefficient, for price to be efficient, right? And that's what you saw here, right? Price had to retrace back into this demand zone before another leg up, right? And that's the same thing that's happening here as well. You see that price actually took out these liquidity again, traditional liquidity again, right? And price failed to also come back into this demand zone, right? Price failed to come back into this demand zone. Instead, it went ahead moving upwards. Now, so if you actually, let's say, for example, oh, you're going to say, oh, there is a breakup structure here, there is a breakup structure here. And because there's a breakup structure here, you're going to just use this order block, try to take a trade from here to the upside. You're going to get a loss, right? You're going to get a loss. Now, this is why so many traders always get losses in the market. Why? Because below their stop loss is price inefficiency, right? And this zone here is so much liquidity. There's so much liquidity lying at this zone, right? There's so much liquidity here, right? Because fractional liquidity has been taken and price is expected to come into this zone, get some orders, right, before it push to the upside. So imagine if you're taking a trade and below your entry is a huge liquidity, right? Price is always going to find a way to drive it down. So you become a liquidity eventually, right? Now also look at this scenario here as well. Look at this scenario here. Price, okay, this is our first, let's say we use this as our change of character, right? Because all the way here, price was creating series of lower lows, right? And then we got our change of character here, we got this as well, and then we got all of these highs taken, right? But price failed to correct into this zone properly, right? Price failed to correct into this zone. And look at what price did afterwards. Price had to come back, right? Price had to come back into this zone, right? Into this zone. So you wouldn't want to be trading a market when there is an inefficiency, right? When there is an inefficiency. Look at this as well. Look at this as well. Price took out this liquidity here. Price took out this liquidity here. This is an inefficiency already, so let's use this one. Let's use this one here. Price took out this liquidity here, and look at what price did. Price reversed all the way, right? All the way. Now, so this is what you're going to note, right? So whenever a transactional liquidity is taken, right, this way, you expect price to retrace to at least 50% of this Fibonacci retracement, right? So you're going to measure from the high that was broken, or if it's a downtrend, the low that was broken, right? To in the case of a downtrend, the higher low and the higher high that was taken, right? And then you expect price to correct all the way to 50% of these, right, to the discount zone before another leg up. If price does not come to this 50% zone, do not be interested in taking a buy, right? Because you're often going to be used as liquidity, right? Price can decide to create structures like this and still come back to take you out before it pushes to the upside, right? So this is what you want to note about transactional liquidity. Now, so let's move to the next type of liquidity, which is which is structural liquidity. Like I already said, this is the most important liquidity. You wouldn't want to miss out on this. So pay rapt attention to structural liquidity. Now, so let me give us a structure here. So oftentimes when price is moving this way, right, we are going to have something like this, and then we're going to have a breakup structure, and then price is going to come back, retrace, right? After the transactional liquidity has been taken, then price is going to give us another push to the upside, right? To take the transactional liquidity again. So here we say this is a change of character, right? And then we say this is what? This is a sweep of liquidity, right? Now, when this liquidity is swept, let me change the color of this to blue, right? Now, when this liquidity is swept, this low here becomes a protected low. This becomes a protected low, right? So this is our protected low. And now we have our change of character here, which is also a transactional liquidity that has been taken. And then price retraced, right? So this is an efficient market. And then price also took out another high to give us what? To take out another transactional liquidity, right? Now, so what do we expect price to do? We still expect price to, most basic market structure traders are going to do something like, are going to expect price to do something like this and then move to the upside, right? To continue the trend. But this is not what always happens, right? This is not what always happens. Rather, what price is going to do is price is going to try to come down to take out this low right here before another push to the upside. And when this low is taken out, it is not a change of character, right? Lots of basic market structure traders are going to say when this low is taken, they are going to say, oh, now there's a change of character, and they are going to start selling from this zone, right? But oftentimes, price is going to, take all of their liquidity away, right? So now this zone right here, this here, we refer to this zone as a transactional liquidity. Here is a transactional liquidity. So you can call it SLQ, right? You can just say SLQ, structural liquidity. Here is our structural liquidity, right? This is our structural liquidity, our SLQ. Here is our protected low, right? We don't expect price to take out this low. What we expect price to do, we expect price to just retrace, take out our SLQ, and then a push to the upside, right? Now, this is what we expect from price. Now, so in a simple term, using this abbreviation here is going to help you to, get familiar with this structural liquidity. Now, so what's the structural liquidity? The structural liquidity is the last high. This LH means last high before main high, right? I'm referring to this now. This is a case of an uptrend, right? This means last high before main high. Last high before main high. And this is what? This is last low before main low, right? Last high before main high and last low before main low. Now, this is for an uptrend. This is for a downtrend, right? Now, where is the last low before the main low? This is the last low, right? Now, why do we refer to this zone as our main low? Because this is the low that swept liquidity. So there must always be a sweep of liquidity for this low to be protected, right? Now, once price takes out this liquidity, this low becomes our main low, and then the low that is next to this low becomes our structural liquidity. So our structural liquidity always has to be what? The last low before the main low. So this here in this scenario, this is the last low before the main low. So let's say we have a scenario like this. Let's say we have a scenario like this where price is, moving this way, where price goes on to create series of, highs this way, maybe something like this, right? Your structural liquidity still remains the last low before the main low. Now, in this scenario, where is our last low? This is our last low, right? This is our main low, right? Why is it our main low? Because we had a sweep of liquidity here. So this our low is protected, right? So, and we have our transactional liquidity taken here, transactional liquidity all taken here, right? Now, where is our last low before the main low? This is our last low before the main low. So this low right here is our structural liquidity. So what is our anticipation? That we are going to place our buy position here, and the price is always going to come back. Price is always going to come back. Sorry about that. Price is always going to come here, take out all of these lows, right? Then it pulls to the upside. So anyone trading, trading here, their stop losses here, stop losses here, stop losses here, right? All will be taken. All will be taken by price, right? So this is why this understanding this liquidity concept is very important. Now let's go to chart examples so we can see what I'm talking about. Okay, let's just quickly look at this chart. I think I dropped this chart on my Telegram channel. I dropped this chart. Yeah, I think I posted about this chart. Now, why did I take this trade? You're going to agree with me here that we have a sweep of this low here, right? And we have a sweep of this low here. This low was taken out. And also we got a more like a change of character here, right? You can call this a change of character, whatever I want to call it, right? And then after price did this, price eventually retraced, right? Price retraced after taking out this transactional liquidity, price retraced to give us the what? Or B, right? So that means after this sweep of liquidity here, this our A became protected, right? This A became protected. This is now a protected low. And now we have a transactional liquidity here, right? And then we have another breakup structure to the upside, right? So transactional liquidity was taken here for a change of character, and then we have a BOS here, and then we have our low here, right? And this low means our structural liquidity. So here is our LCLQ. Why? Because our LCLQ is the last low before the main low. So how did I take this trade? I place my buy position here and I cover this low right here, and then I targeted 1:3, right? So you can see that. So that was how we got a beautiful trade, trading this type of liquidity, right? So understanding this concept alone will make you so much money in the market because it always happens. It always happens. Let's look for another example quickly. Um, Okay, here's another beautiful example. So this is it. Just look at this here. If you agree with me, this is a sweep of liquidity here. Price took out this low right here, right? And then price did something like this. So here, this is a change of character, right? And this is a sweep of liquidity. So now we have a sweep of liquidity. So that means this zone here becomes our protected low, right? So this is now our main low because we have a sweep of liquidity. And after price swept this liquidity and gave us an A, price went on to break structures and eventually came to give us a what? A B, right? A B, or you can call it your SLQ, you can call it a B or SLQ, whichever you want to call it, right? You can call it SLQ or structural liquidity, whatever you want to call it. Now, why did and then price went on to give us a what? Another BOS, right? So you see another BOS here, the BOS here, and another BOS after our SLQ was formed. Now, why did we select this as our SLQ and not all of these lows that were formed here? Why? Because the last low before the main low is our LCLQ, the last low before the main low. So if you want to take this trade now, you're just going to place our buy position here. So we're just going to select this zone here, place our buy position here. And so let me try to cut price and show us how this played out, right? How you can do your markup. Okay, so let's say you have a structure like this that has not played out yet. You just have this structure playing this way. What you're going to do is identify your zones, right? So now you know that this is your protected low, right? And you know that this is the last low before the main low, right? And you know that price is always going to come back to take the last low before the main low. So you're going to place your stop loss just below this low here because you are now confident that this your last low is not going to be taken, right? Because it has swept liquidity here, right? So you're just going to draw your take profits to this swing structure here, or this swing target, right? And then let's play price and see how price retraced. So you can see that C price coming all the way down. Let me pause this and just say something quickly. Now, after this break of structure, you agree with me that lots of market structure traders, just basic market structure traders, they are going to place their buy position here, right? Because they believe that, okay, price is going to react from this order block. And this is supposed to be a very good order block, right? Because it even, there is an imbalance before the order block, right? So this is supposed to be a very strong order block. But price did not respect it. Why? Because it is a structural liquidity, right? You see, somebody that trades a basic market structure would have gotten a loss here, right? While we are still waiting for our trade to even be activated, right? We are not in a rush. We know what we are doing, so we are not panicking. And just look at that. And just look at that. Beautiful, beautiful, beautiful trade. All right. All of these. Now, when all of these, all of this movement happens, we're not shaking because we already know that price is going to go all the way up to take out this high, right? After taking out our structural liquidity, right? So this is how you trade structural liquidities, right? Now let's look for one more example and then we can go on to the inducement liquidity. Which pair will I use? Which one? Which one? Which one? Which one should I use here? Okay, let's go with euros since it's my first here. So let's go with euros. And one thing about this structural liquidity, the reason why you shouldn't play with it is that it works with all pairs. It works with all pairs and it works with all markets, all financial instruments, right? So this is not a strategy that works with Forex and doesn't work with crypto or synthetic. This works with Forex, it works with crypto, it works with synthetic, even with options, right? So any market with indices as well, any market you want to trade, all futures, right? So let's do this quickly. So you can see here we have a sweep of liquidity, right? We have a sweep of liquidity here. So that automatically means this low is now a protected low, right? Now, before this low became a protected low, we had a sweep. And then after the sweep, we had a change of character, right? So if a change of character did not happen, you cannot consider your low as a strong low, right? You need to have a sweep and then a change of character afterwards before this low becomes a strong low, right? Now you can see that we see what happened here. We had our break of structure here, right? And then see what happens. Price came all the way, price retraced all the way, and it came to take out our what? The last low, right? The last lows before our main low, right? You can, if you use your Fibonacci to measure from this zone here all the way here, you're going to see that this zone here, these are structural liquidity we use here, was well within the discount zone, right? Always make sure, always use your Fibonacci tool to make sure whenever you're selecting your structural liquidity, always use this Fibonacci to measure from the high that was broken, right, to the low that was responsible for the break. That's in the case of an uptrend, right? You need to make sure it is well, your B has to be in the discount zone. If the B is somewhere here, let's say if the B was somewhere here, we will not consider it, right? Because this is an inducement clearly, right? So you want to always make sure of that, right? And let me talk on this quickly so you don't get confused. Some of you might be wondering, maybe this is price just took out this liquidity, right? So you're expecting that, okay, price that will come here, give us our B and then go up, this will become our structural liquidity, just like, and then here will become our low, right? If this is you, let me quickly explain something to you so you can understand this. Now, so we have two types of this structural liquidity, right? Let me just make it clear. We have the first one this way, where price, takes out the liquidity, change of character, we trace before another leg up, right, to give us our B here, right? So here becomes our strong low, here becomes our structural liquidity, and then we expect price to come all the way here, take our B and go up, right? So this is the type 1 or the type A, right? And then we have our sweep of liquidity here. You can call it model 1, type A, whichever you want to call it, right? And then we have another one here as well. We have the type B here, right? So this is a type B, right? Where we have our change of character here. We have our sweep of liquidity here. But before our sweep of liquidity, before our change of character, price give us what? Price give us a B here, right? Or a structural liquidity here, right? And here becomes our protected low. Why? Because it swept liquidity and now we have a low, right? So we expect price now to come all the way, take out this, right? Before we move to the upside. And that's the example we just dealt with, right? If you look again, we have the sweep here and we have a break here, right? Now, before we got this change of character here, price gave us our B here, right? Our B, right? And price came back. And then here's our low, right? You can see that price came back and gave us a good trade from here, right? A good trade from here, right? So you can see how this works. So if you took this trade or if you understand this concept, you would have, taken a very good trade from here and make money for yourself already, right? Now, so quickly, let me just tell us some of the rules that governs this structural liquidity, right? The number one rule is that your B has to be close to your A, right? This is a type 1, right? Your B has to be close to your A. Your B has to be close. Like I already said, your B will always have to be in the discount zone when you use your Fibonacci to measure from the high that was broken to the low, right? To the low. Your B will always have to be in the discount zone. Now, for those that are new to this channel and probably new to this video, if you want to, get my Fibonacci configuration, this is how it is, right? This is how it is. Just these three ticks, 0, 1, and 0.5, right? So let's go back to the video, right? So this is what? This is our strong low, our protected low, our main low, and then this is our B, right? Our B always has to be the last low. This is a sweep, right? The last low before the main low, and it has to be very close. It has to be in the discount zone, right, as well. It has to be in the discount zone for it to be valid. If your B is far, let's say you have a B this way. Let's say your B is somewhere here, right? Let's say your B is somewhere here, and then your here is your A, and your B is somewhere here. Price is always going to, let me do it. Let me just give us a new sketch here. Let's say you have your B this way. Let's say you have let's say you have your B this way. Or your structural liquidity, sorry, your structural. So please, whenever I say B or SLQ, I'm referring to structural liquidity, right? So let's say you have your SLQ this way, and then here is your low, your main low, and then here is your sweep of liquidity. Now let's use the FIB tool to measure from this high that was broken, right? Where we have our change of character. You can see that our B is not within this discount zone. Now, if our B is not within this zone, it means our protected low will be used as liquidity. What price is going to do is, before price will, walk all the way down from this zone to your zone, price will be hungry again, right? So price would come here, take out this liquidity before it eventually move to the upside, right? So you always want to make sure that your B is very, very close to your A, right? If your B is not close to your A, it's not valid. It's not a valid structural liquidity, right? So let's move to let's talk about the last type of liquidity, which is the inducement liquidity, right? This is also an interesting type of liquidity, inducement liquidity. Now, what is an inducement? Now, you have something like this. You have price moving this way, and then it goes on to change character, right? And then it never retraces, just keeps going, right? Where you have this as your sweep, so you're going to say, okay, because you have a sweep now, this is going to be your strong low, right? This is now a strong low. But instead of price to, just come the way down here, give you a B and then go up, price will not do that. Instead, price will just rather keep coming this way. Price will rather keep coming this way, coming down this way until it takes out this B here, right? And then boom to the upside, right? So we say this structure, this inducement liquidity is used for expansion. Whenever price takes out an inducement, price expands. Remember, we said the first one is transactional liquidity, which is used for retracement. And then we said structural liquidity is for continuation. Once price takes it, it continues the trend. And then we say this inducement is used when price takes our inducement, it is for expansion, right? Now, so this is why we don't trade like basic market structure traders. So because you have a sweep of liquidity here, for some of you that will be over dead spirit and overzealous, I don't know the word to use for that. Some of you, once you see a sweep of liquidity here and you have your liquidity here and you have this break here, right? The next thing you guys will do is to just start setting trades. You just start setting your trades because you'll be like, oh, I know what is going to happen. You know that feeling when you feel like you know so much and then you just set your trade. You just be waiting for the market to just come back. You're going to get a stop loss. You're going to get a stop loss, right? Price will do something, take you out, and then immediately just boom, right? And this is even more painful, right? Price will just take you out by just maybe one pip or two pip, a little, and then it will move impulsively to hit your take profit. And that will be very, very painful, right? So you will not want to do anything until you have your full algo structure or you have your full structure this way, right? Until you have your A, your B, you have your low, your structural liquidity, everything checked, right? Before you go ahead to set your trade, expecting that price will come down to take out this before it moves to the upside, right? So let's quickly look at example of the inducement liquidities in the market. Let's see. Let's look for a downtrend this time. Okay. All right. Look at this. Look at this. Let's examine, whichever it is pronounced, this zone, for example. You see here, price took out structural, this price swept something here, right? This is a sweep, right? And then afterwards, price took out this, right? Price took out this here, and then eventually came to, break this, right, to the downside. But it did not, create a structural liquidity. Price was supposed to maybe give us something like this, just like the way it did here, and then come down here, right? To then we expect price towards to retrace, take our SLQ, and then give us a good trade to the downside, right? But price failed to give us that, right? And look what happened. Look what happened. Price came and took it out. Price came and took out this low. And this is what I just said, right? Once price takes it out, price will just, start expanding down to the downside. So imagine if you were overzealous, or if you, you thought you knew too much, and then instead of you to wait for price to give you a structural liquidity first, once you see this break now and this sweep and all of this, you just go ahead and place your trade here, right? And then you cover this low. Maybe you just place your trade here, you cover this low here. Look at what price will do to you, take you out, and then with the next candle, just sell to the downside. So this is how inducement liquidity works, right? So guys, I hope you found value in this video. If you did, please go ahead, subscribe, like this video, and then share with your friends, right? So they can also be enlightened about how the big boys trade the market. So I'm going to leave a quiz in the comment section just to test your understanding of this concept. Go ahead and attempt this quiz, and I'll go through your comments, I'll go through your answers and let you know if you're correct or not. So thanks for watching, guys. Peace.